The Fed is holding interest rates steady, affecting mortgages and savings rates, with a potential impact on $11 trillion in home equity. This decision could cost homeowners an additional $1.4 billion in interest payments over the next year. If you're a first home buyer looking to understand how the current interest rates will affect your mortgage and savings, this video is for you. You will learn how the Federal Reserve's decision impacts interest rates, the effects on mortgage rates and home equity, and how to navigate the current housing market as a first home buyer. What are interest rates? Interest rates are the percentage at which you can borrow or save money. The Federal Reserve, also known as the Fed, sets these rates to control inflation and stabilize the economy. Currently, the Fed has decided to hold interest rates steady at 4.5%, which means borrowing money will remain relatively expensive, but saving will continue to earn a decent return, around 4.2% APY. How do interest rates affect mortgage rates? Mortgage rates are directly influenced by the interest rates set by the Federal. With interest rates holding steady, mortgage rates will likely remain around 5.5% for a 30-year fixed loan. This means that for a $300,000 home, your monthly mortgage payment would be approximately $1,700, including principal and interest. What impact does this have on home equity? Home equity is the value of your home minus the amount you owe on your mortgage. With $11 trillion in home equity at stake, the decision to hold interest rates steady can have significant implications. For example, if you have a $200,000 home with a $150,000 mortgage, your home equity is $50,000. If interest rates increase, it could become more expensive to borrow against your home equity, potentially reducing its value. How will savings rates be affected? Savings rates are also impacted by the Fed's decision on interest rates. With rates holding steady, you can expect to earn around 4.2% APY on your savings account. This means that if you have $10,000 in savings, you can earn approximately $420 in interest over the next year, which can help offset the costs of higher borrowing rates. Navigating the current housing market. As a first home buyer, it's essential to understand the current housing market and how interest rates will affect your purchasing power. With interest rates steady, it's a good time to consider buying, as mortgage rates are relatively low. However, it's crucial to factor in the potential for rising interest rates in the future, which could increase your monthly mortgage payments. For instance, if interest rates rise to 5.8%, your monthly mortgage payment on a $300,000 home could increase by $100. Key takeaways. In summary, the Fed's decision to hold interest rates steady will have significant implications for first home buyers. Remember, interest rates affect mortgage rates, home equity, and savings rates. It's essential to understand these concepts and how they impact your financial situation. As a first home buyer, you should consider the current interest rates when making your purchasing decision and plan accordingly for potential future changes. Click the link in our description to learn more about how to navigate the current housing market as a first home buyer and understand the implications of interest rates on your financial situation. Don't forget to subscribe for more first home buyer tips and stay up to date on the latest market trends.